Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited today to discuss market crash equals conversion opportunity for Roth Solo 401k conversions. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So in today's session, here's what we'll cover. In these uncertain economic times, many of you might be wondering about strategies to optimize your financial future. Today, we're going to dive into a topic that's particularly relevant when markets experience a downturn: Roth conversions. We'll explore why a market dip isn't just a challenge, but a unique and powerful opportunity to supercharge your retirement savings, specifically through Roth conversions. My goal today is to equip you with the knowledge to understand why converting pre-tax assets, like those in your solo 401k when values are depressed, can lead to substantial tax savings and long-term financial growth. Let's start out with the basics. Who qualifies for a solo 401k? Self-employed individuals and owner-only businesses with no full-time, non-owner, non-spouse employees. You must have self-employment income. So you need to report, for example, income on your 1040, on Schedule C, for example. If your business is taxed as a sole proprietorship, could be a single member LLC taxed as a sole proprietorship, or W-2 wages would constitute self-employment income. For example, for a business that is taxed as an S Corp or a C Corp. Finally, income reported on line 14 of a K-1 in the case of a business taxed as a partnership would constitute self-employment income. So the key is to have that earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. Now, if you have questions regarding this topic or really any even off-topic issues, don't hesitate to chat it over, as we're happy to discuss questions or topics. But we'll proceed again with discussing market crash and how that can create a Roth conversion opportunity. So specifically, when the market is down, individuals will sometimes want to convert assets in kind while the values are depressed from a pre-tax status to a Roth status, because that means that they'll pay taxes on the lower value with the idea that eventually those asset values will come back and the growth will now be inside that Roth account where you'll have that potential for tax-free growth. So that's the opportunity in a nutshell. When the asset values are down, pay the taxes, move it to a Roth account. Then once the value comes back up, all that gain can potentially be tax-free. So let's take a very simple example. Let's say the individual has 1,000 shares at $100 a share. So the value of those assets is equal to $100,000, right? $100 a share at 1,000 shares. Let's say the market drops 10%. So now those asset values, those shares are valued at $90,000. So if the individual were to convert those shares at that time, they would pay the taxes on the value of the assets at the time of the conversion. So now 90,000. But if those shares go back up to 100 or even more, all that potential growth in the value of the assets can now be tax-free because it's inside of a Roth account, assuming at the time of the distribution, you're able to take a qualified Roth distribution. Moreover, there are additional benefits of having the assets now inside a Roth account. For example, no RMDs. RMDs are required minimum distributions. In other words, once the individual reaches a certain age, the government requires them to take a distribution from that retirement account. Well, historically, RMDs did not apply to Roth IRA accounts, but thanks to Secure Act 2.0, now Roth 401k accounts have been aligned in that regard. In other words, RMDs don't apply to either Roth 401ks or Roth IRAs. So if you have a solo 401k, like the one that we offered by my solo 401k Financial, that allows for Roth solo 401k funds, that allows for in-plan Roth conversions, you can exercise this strategy, right? You may have a brokerage account at Fidelity or Schwab for your solo 401k, where you're invested in a specific asset and the value of that stock comes down. The individual transfers the asset in kind from their pre-tax solo 401k sub account to their Roth solo 401k sub account. And then if the asset comes back up in value, now that growth will be inside of a Roth account where it's potentially tax-free, so that as long as when you take the asset out or you liquidate, you do it as a qualified Roth solo 401k distribution. So you've had the account for at least 5 years and you're at least 59 and a half years of age. So all that subsequent growth would then be tax-free. So the fact that you could take tax-free withdrawals means you can manage your income strategically, right? You've got access to this tax-free income, essentially, once you're able to take those qualified Roth solo 401k distributions. Moreover, there can be an estate advantage in terms of estate planning, where your heirs may be able to get those assets inside the Roth account tax-free as well. Now, when someone is deciding whether to take advantage of a market crash to implement a Roth conversion, there are certain planning considerations, right? And again, we're just providing this for educational purposes only. You're going to want to discuss with your specific tax and financial planning advisors about your situation. But considerations that are going to be on the table are going to be, okay, what's my tax bracket now versus in the future? Obviously, no one has a crystal ball, but you can forecast, right? And you might anticipate a certain tax bracket in the future. Additional considerations would be to use non-retirement assets to pay taxes, right? Because when you convert that asset from a pre-tax status to a Roth status, you'll have to pay taxes now at the time of the conversion at the hopefully lower value. So you can use non-retirement money to pay those taxes, and that'll preserve your retirement account balance. Now, when you do that conversion, that's going to add income to your income now. So another important consideration may be, okay, well, would this push me into a higher tax bracket where I'm now paying at a higher percentage? So some individuals may want to do it carefully. Well, they'll take it right up to the line where it doesn't push them into the higher tax bracket, but allows them to convert as much as they can while staying in their target tax bracket. You might want to also consider a multi-year strategy, right? Like if you do some this year, then some next year, right? Depending on these other considerations as well, to spread out the tax burden. Ideally, you'll want to convert after a market dip, all right? It's hard to time it perfectly, and it's probably impossible. But there may be trends, right, where you feel like it's in a dip where there's a potential now for it to come back up. So typically you want to avoid trying to time the bottom because it's almost impossible to nail it right at the bottom. Systematic annual conversions, like we talked about, opportunistic top-ups. These are other strategies that individuals will pursue. And this is not just coming from us. I mean, there's real world wisdom out there where advisors will recommend this as a tool in the toolbox in terms of your tax and retirement planning strategies to convert when the market is down, per Kiplinger's Market Watch, treat as a retirement, buy the dip. Common pitfalls. We sort of alluded to one already, which is the tax bracket surprises. So it's good to coordinate with your tax advisor. Just lack of liquidity for taxes, right? Because now this is, maybe get a bigger bill than you anticipated because you've added that income for the year of the conversion. Maybe being overly aggressive in 1 year. So we talked about how some individuals want to spread it out over a multi-year strategy. But in short, I mean, the takeaways are, again, how one can now view those market dips as really a Roth conversion opportunity. Evaluate the income, bracket, and cash flow, as we discussed. Consider maybe partial conversions or a multi-year plan. And of course, as always, consult your tax advisor. And then finally, just an action list, right? To start to put together a plan in terms of being able to track the dips, estimate the tax impact, confirm the cash for the taxes, plan your schedule review annually with your advisor. So really develop the system around this process. We appreciate the chance to discuss these topics. We invite you to continue the conversation on our community, mysolo401k.net/my community. It's always free to join. All are welcome. It's not just for clients. It's really for all community members. We have forums. We have a library of videos and webinars. There's over 30,000 members. So it's a vibrant community. So if you're not a member, we invite you to join. Please also subscribe. We go live twice a day with content that we like to share, but we also welcome the opportunity to discuss questions. So if you have questions, don't hesitate to chat them over, either now or on future sessions, as we love the opportunity to discuss these topics. All right, well, until next time, we appreciate the opportunity. Take care, everyone.